Hello everyone. In August 2024, Canara Bank successfully issued the 81 perpetual bonds after a long period when such bonds saw weak demand in India. What makes this interesting is that the investor appetite revived, but not because of the risk disappeared, but because the valuation rules changed. This makes it an important case in Indian fixed income markets. Canara Bank is a public sector bank, and the 81 perpetual bonds are a special category of bank capital instruments that are designed to absorb losses. Now, these bonds are perpetual in nature, meaning they do not have any maturity, and they also carry a high risk credit and a regularity risk. After events like Yes Bank write down and the global 81 controversy, investors became extremely cautious. So this issuance matters because it signals the renewed confidence, but driven by the structural changes rather than reduced risk. Now let us understand how these 81 perpetual bonds are actually valued.
From a fixed income perspective, 81 bonds are perpetual bonds. In theory, a perpetual bond is valued as the annual coupon divided by the required yield. However, in practice, 81 bonds are much more complex because they include embedded options and credit risk. One key feature is the embedded call option. The issuer, Canara Bank, has the right but not the obligation to call back the bond after a certain period. This creates reinvestment risk for the investors because if the interest rates falls, the bank is likely to call the bond, limiting investors' upside. So, the investors demand a higher yield to compensate for this call risk and perpetual maturity and the possibility to write down or conversion. This makes 81 bonds closer to equity-like risk, even though they pay fixed coupons. So, despite these risks, demand revived in 2024. Let's see what exactly happened.
Earlier, mutual funds were required to value 81 bonds conservatively, often assuming they would not be called. This pushed price down and increased the volatility, making these instruments unattractive for the institutional investors. In 2024, valuation norms were clarified and aligned more closely with the market-based pricing. These allow mutual fund to value 81 bonds, assuming the call option would be exercised subject to the condition. As a result, the yield will be the become the predictable and the price stabilized. These changes is supported by the regulatory guidance and the reported credible sources with the RBI communication, rating agency report communication, and the rating agency report financial news.